Hi, welcome to Market in a Minute. We think the rotation started. So we talked about this 2 weeks ago that we thought a rotation would occur, followed by a pretty significant decline in the overall markets. Historically, these rotations are flipped from growth to value or value to growth can last a number of years. So we think that we're going to get the rotation, followed by a correction, if not bear market, followed by continued rotation into the rest of the overall market. So the other part of the market that has not performed in the last several years, especially the value and small cap stocks. The small cap area can be a lot of fun in this environment. So just to review what's going on in the stock market, the stock market's roughly 23 times earnings, this year's earnings, and it got to as high as 24 times earnings in 2000, the projected earnings. So I'll show you some more graphs on that. We got extreme reading on the number of stocks that were outperforming the S&P 500, extremely low. So only 25% of stocks this year have been outperforming the S&P 500. Generally, when this occurs, if it lasts for a while, you get this massive rotation into the rest of the market. I think we're starting to see that. Expectations for earnings growth for this year is picking up. So it looks like the second half of the year, we're going to see some nice growth if we don't dip into a recession. And in 2025, we have pretty high expectations for growth. Probably not make those expectations, but the trend is in the right direction. And more importantly, what's happening is it's broadening out. So it's just not one sector of the market, mega cap tech, that's driving the earnings. It's amongst all the sectors of the market at this point that are going to be driving earnings next year. The economy is clearly slowing. The labor market is weakening. We think the Federal Reserve will likely cut interest rates in September, maybe again in December. And if all goes well with inflation, you might see 4+ cuts next year. So we think the odds of a recession are high. However, the Fed might dampen that down by starting to cut rates. They may not be timely enough to stave off of a recession, but it might dampen that recession. So they're perhaps starting before the recession starts, which is not usually the case. Small cap, we see huge upside in small cap, particularly individual stocks. So we think a rotation will occur over time into that small and mid cap area, and also those really good blue chip companies that are trading at big discounts to the overall market currently. So we see value in the blue chip stocks. So we have a number of names that we like there. Quality, consistent growers that are growth and income type of securities. The S&P and the NASDAQ, they're technically overextended. They're well overdue for a correction. We think we could get a 10% correction this quarter. And I was a little surprised by what happened on Thursday is we had a fairly good-sized decline in the S&P 500 and NASDAQ, yet the rest of the market went up nicely. So that was maybe encouraging that it doesn't have to be the entire market that drops if technology does drop. We are entering a seasonally weak period, so we see the weakness might extend into October this year, but August, September tend to be really tough months. The major risk that we see is that the Federal Reserve might be a little bit too slow in reacting. Inflation remains stubborn, and so interest rates may stay higher longer than expected. That's the risk. I think that side of the risk is diminishing. So we think the Federal Reserve is really bent on cutting rates. We're a little concerned about the inflation still, but I think they're dead bent on cutting rates as soon as they possibly can. The rotation followed by a significant drop is our outlook, as we discussed. And so again, we think that rotation could last a number of years. And I'll show you kind of the history of that a little bit. It's really concerning what happened over the weekend with the potential assassination of of Donald Trump, and Donald Trump's policies play into this theme that we have. It's not necessarily because of Donald Trump, but everything's set up to have this rotation. And we think Donald Trump, if he's elected president, it creates a better environment for that rotation into everything else that has not been performing well because the economy picks up strength. So rotations can last many years, and we think that this particular rotation could be, 3 to 4 years in duration. The CPI report was really the catalyst to get this thing going. So the CPI was a little bit lower than expected. It was great relief. It kind of set the stage for the Fed to cut interest rates. So over a 3-day period, the small cap index, the Russell 2000, went up 7.5%. I don't know if you remember this, but we talked about Red Cat about a month ago. It's a provider of military drones. We like the stock. You could see that it popped above that 200-day moving average there, and then it's darn near doubled over that period of time. So if you're a good stock picker in this environment, this small cap environment, I think you can make a lot of money. So as you know, we really like biotech. Biotech set up really well to perform well in this rotation. So we put these type of stocks into our tactical strategies. So for instance, Red Cat was in 2 of our tactical strategies that we put individual stocks into it. So it gives a little spark to the performance. Also, we have a small cap biotechnology strategy. That's done really well this year. I think it has great potential. A lot of our stocks have a lot of catalysts to them. Growth outperforms value. You could see that occurring in the 1996-2000 period. Now, last week we had a really good chart of this. You might want to go back and look at that as well. But in that 96 to 2000 period, growth outperformed value by 3x. Okay, and then value crushed growth, by a similar amount, but it did it the opposite way. Value was up 50%, growth was down 29% in 2000 to 2007. So even going through that bear market, you had some years positive growth in the value stocks. In this cycle, it really kicked in a big way in 2014, but this cycle's lasted about 16 years, and the performance from 14 to present is about 4x. So it's very similar to the performance in 96 through 2000. So we think it's set up to begin to see that rotation occur to the other areas of the market. Valuation. So I wanted to go through this because we saw this in 2000. It was a very important part of why it rotated. Cisco was the darling back then, like Nvidia is now. Cisco got crazy in terms of valuation. It never really recovered, but Cisco was the arms dealer to building out the internet, like Nvidia is the arms dealer to building out AI. So we think maybe both stocks are on or were on a similar path, and Nvidia on a similar path as Cisco. So just looking at the S&P 500, obviously the mega cap technology stocks are driving this valuation increase up towards the high end of those blue wings. So this is a really nice thing that Ed Yardeni puts out. You can see over time where we are in the valuation versus history, and you can see we got right around 25 times earnings on the S&P 500 in 2000. We're about 23 times this time, and the normal valuation, if you look over this long period of time here, you can see that blue wing there, it's about 15 times earnings. So if we would go back to 15 times earnings without changing any of the earnings estimates, we would see a drop of about 35%. And then you look at the other indexes. So this is mid cap. Mid cap is in the middle of its range at 15 times, so that's pretty normal. We think mid cap should sell generally at a premium to the larger cap as they grow faster, and especially the small cap. The S&P 600 is trading at 15 times earnings, very similar to the mid caps. But again, if you're a good stock picker, there's a lot of stocks in the small cap area and mid cap. If you can pick out the right ones, you can make a really good return. Obviously, there are some risks. Now, just think about this. The Russell 2000 is a little bit less than $3 trillion in market cap. That equals just one of the mega cap, technology stocks at this point, one of the top three. So one of the top three encompasses the entire index of the Russell 2000 market cap. So if the market decides it wants to rotate, you could see maybe a really exaggerated move into these small cap stocks, and it could last a while. Upcoming data. So on Tuesday, we get retail sales. So retail sales are going to be probably negative. So retail sales is a real number plus inflation. So when GDP is reported, it's always a real number. So if the real number for retail sales will likely be nicely negative if the nominal number is negative. So what I'm saying there is it's concerning that we're probably going to get negative retail sales. That'll probably bump down the expectation for GDP growth for this quarter. On Wednesday, we get J&J reporting. J&J should have a reasonable quarter. We're looking for them to talk about the talc powder litigation. If we can clear that up, we got a really nice move in the stock. And then Halliburton and Schlumberger report on Friday. So we think both stocks will probably lift on that. You can see here, this is Halliburton. We bought Halliburton. We like Halliburton. We like both stocks, actually. You can see Halliburton held its support line. It popped above the 20-day, and now it's above the 50-day. We really like when stocks start to break out like this. So above the 50-day, hopefully it gets above the 100-day and then above the 200-day moving average. But we really like this sort of trend in stocks where they're set up where there's multiple moving averages in front of them with the 200-day at the end. So hopefully we can see another move like it had back in February, March, where it broke all the major moving averages to be up significantly over the 200-day moving. Thank you very much. Again, we're looking for that rotation, and it could last a while. We like this environment. However, we are concerned about a correction. We're less concerned about it impacting this overall sector of the market. So we're being a little bit more aggressive, but we are ready to move to being completely defensive if we need to. So our goal is to protect the downside in all of our portfolios as much as we possibly can in a bear market. Thank you. Please hit like and come to my website, Patrick Adams CFA, and sign up for a hard copy of Market in a Minute, and we'll send it to you every week. Take care.